Good morning. Hi, this is Steve Ogier with ContraVest, and today I want to talk a little bit about investing. When you're looking at any type of investment opportunity, whether it's commercial real estate, whether it's buying a business or investing, you need to understand what you're being asked to invest in. And there's only two forms of finance. That's debt and equity. So when you're looking at investing, you got to know which one of these are you participating in, debt or equity. So I'm going to use an apartment community, and we're an apartment developer to demonstrate some of these simple concepts that you need to be aware of. So first of all, when you're investing in any business, there's usually what they call a capital stack. So in the capital stack, you'll have equity and you'll have debt. Debt is typically brought in by the bank where you get a loan, and equity is usually cash. So understanding how much of the capital stack is cash or equity and how much of it is debt. Now, debt has its own set of flavors, and that's a whole nother video in itself, but you could have primary debt, you could have secondary debt, you could have mezzanine debt, but again, we can talk about that in a later video. When we underwrite an apartment community, there's three metrics that we look at. First of all, the first one is return on cost. The second one is return on equity. And the third is internal rate of return. So the metrics that we look at when we're underwriting an apartment deal, and we'll go through each one of these here, the return on cost, what most of our investors are looking for today, and most of our investors are institutional grade insurance companies, pension funds, and the like. They're underwriting the return on cost at between 6.25% and 7%. They're also solving for a return on equity, which some people will call a cash on cash return, meaning the cash you have in the deal, what is the return on that cash? And then the internal rate of return on the deal is they're solving for roughly 18 to 20%. Some people will say high teens, low 20s, but you can only count or calculate the IRR once you've exited the investment. So some people talk about internal rate of return ongoing. Well, that's not necessarily the case. You have to wait till you exit the investment before you can calculate the internal rate of return. So the first thing when we calculate return on cost, we look at the cost of the deal. So first of all, typical apartment deal, let's say 300 units. Today that costs roughly $250,000 a unit to develop. So this deal would be roughly a $75 million deal. So if you had all equity or all cash, it would cost you $75 million to do this apartment deal. So this is what we call the cost. So to determine what the return on cost or the income, we got to determine what the income is. So first of all, we take the apartment community, we figure out that, hey, we have 300 units. If we collect $2,100 a month, it's an annualized income, and return is all calculated based on annual. So 12 months out of the year, this thing would gross roughly $7,560,000 of gross income this asset would produce. Obviously, we have operating expenses, we have insurance, we have to clean the pool, cut the grass, pay our taxes, and the like. So in a typical apartment deal, our expenses are about 33% in this example. Now, the fact that insurance costs have gone up, inflation, this number's gone up a little bit to about 39 to 40%. But for this example, we would have $2.5 million worth of annual operating expenses. So whatever your asset class, if you're in a retail building, you're an office building, industrial, these operating expenses could vary. They won't be the same as an apartment community, but in this case, for this example, we're using 33%. So what happens from here is, there's your NOI, your net operating income. This right here is the magic number. This will determine exactly what the value of this community is. So we use a formula, and sometimes it's referred to as ERV, which is your income over value equals rate. So if we want to calculate the return on cost, we take the income, 5 million, divided by the value, which is the cost. It cost us $75 million to build this property. It created $5 million in income. So we take the income divided by the value. This will give us our return on our cost. And in this case, this calculates at 6.75% return on cost. As we can see, that falls within the parameters here of what the market is currently looking for. So this would be a pretty good deal. Obviously, as my expenses go up, my NOI goes down, and that would affect the return. So development, not everybody wants to do development. It's high risk, there's a lot of work associated with it, it takes a long time. And just like when you can either buy a business or you can build a business, you can buy an apartment community or you can build an apartment community. We're in the building business, so we go from trees to keys. But there are investors that want to buy this income. They like the community, they like the location, they like the continual growth possibilities, and they might want to buy this. So this right now will generate a 6.75% return on cost for me, because I took $75 million to build it. It generated this income based on this rent. We're able to operate the project at this expense ratio. Therefore, my yield is 6.75. Well, there's institutions like pension funds, insurance companies, large investors that love this income, and so their yield expectation is less. We call that a risk-adjusted return, meaning their risk is less, so they're willing to accept a lower yield. So if we take the same formula and we just do a simple algebra problem here, we take the yield, the value, put it over here, put the return under there. So an investor comes in and says, hey, I don't really need a 6.75% return. I'm happy with a 5.5% return. So in this case, we'd say, what are they willing to pay us at what they call a cap rate, the capitalization rate. So an investor is willing to purchase this property for $92 million because they are capitalizing their $92 million at a 5.5% rate, which will yield them $5 million. So the real question is, well, are there investors out there that have a lower yield expectation? So maybe there's an investor that says, hey, I only need a 4% cap rate. So what they do is come in, here's your cap rate. They come in and say, hey, I like this income. I'm willing to purchase it at a 4% cap rate. So what would that value be? $126,500,000. We built it for $75 million, and now we have a buyer who is willing to purchase it at a 4% cap rate for $126. So our profit is the difference between 75 and 126. So that's really the business we're in the sense of capitalizing the amount of money that it takes to, and at 6.75, which will generate the yield of $5 million. Now the return on equity, once you put debt on the project, which is right here, again, the yield will fall hopefully between 8 and 10%. And the internal rate of return, again, is only calculated once you exit the investment. So quick example of return on equity, internal rate of return. If you took $1,000, invested it on January 1st, and you exited that investment on December 31, you would have a 100% return. If you did that same investment, scenario B, on January 1st, and you did not exit on December 31, but on the next year, on December 31, you're in the investment for 2 years, and you exited that for $2,000, you would have a 50% return. So internal rate of return takes into consideration the time value of that investment, meaning how long, what was the return on every dollar while it was in the investment. So this calculation right here is what we use for commercial real estate. But you can take the same calculation when you're investing in a business and understand that they use a term called EBITDA, earnings before interest, taxes, and amortization, depreciation and amortization. This is equivalent to EBITDA, which is basically the income minus the operating expenses. This is what we would call the EBITDA, which this is the unleveraged return. So in any business, you could do the same calculation and say, what is the EBITDA based on, what is the return based on the EBITDA and based on the purchase price? But we use cap rates in commercial real estate, but in basic business purchasing, they use what they call a multiple. So they take a multiple of the NOI and figure out what the purchase price would be. So some businesses are purchased on either a 4x multiple, 4 times multiple, 10 times multiple, or maybe even a software company that has long-term recurring revenue might be purchased on a 30 times EBITDA. So anyways, whenever you're looking at an investment, you need to understand what the return on cost is, and then it's all based on the NOI. So when it comes to valuing a business, when it relates to the EBITDA or the net operating income, for example, this business right here, if you were to buy a business that generated $5 million in EBITDA and somebody was willing to purchase it for $92 million, that would basically be roughly an 18 times multiple. But if you had another buyer that was willing to come in and purchase it at $126 million, you're looking at a 25% multiple. And you'll hear that a lot in businesses is, what is the multiple? You know, if you're buying a financial services business, like I said, buying a software business, those multiples can be very different. For a construction company, a multiple that might be fair in our industry, if someone was to purchase a construction company, it might be a 4 to 5 times multiple of EBITDA, or in essence, the net operating income. So that's just an analysis of the difference you might hear jargon-wise of purchasing a business versus purchasing commercial real estate. We value based on cap rate, the capitalization rate. And again, the cap rate is a function of the open market, which normally is tied to interest rates. So as interest rates go up, the cap rate goes up. As interest rates go down, the cap rate in theory goes down. So for me as a seller, the lower the cap rate, the higher the value of the asset. So for me, a low cap rate is good. On the buyer side, a high cap rate is better. So the same asset purchased at a higher cap rate would sell at a much lower number. So cap rates are determined by the market. The cap rate in Central Florida is very different than the cap rate in New York City or San Francisco or even in Milwaukee. So each market is different. So how do you determine the cap rate? Well, many times you can just call a broker and talk to them, talk to a local banker, somebody that's involved in the commercial real estate in that asset class. Cap rates in apartments are different than cap rates in industrial or retail. So for example, today, because of remote working and distant with technology, there's a theory that office buildings are not being filled up, and there are a lot of vacant office spaces. So the cap rate for an office building is much higher than a cap rate for an apartment. So each asset class has its own cap rate. So when investing in those different asset classes, you need to find out what is the market cap rate at that time, and what do you think the cap rate will be in the future, which everyone's best guess is. There's no guarantee on what the cap rate will be in the future, but that will determine for you what the risk that might be inherent in that investment. Therefore, if we're expecting interest rates to rise, there's the theory that cap rates will rise with it. If we expect interest rates are going to go down, there's a theory that cap rates will go down. So that's how you analyze the risk when it comes to value on commercial real estate. And then obviously with a business, the multiple of that business, someone is willing to pay a higher multiple for a more certain and recurring revenue in any business. Just like in apartments, there's a high multiple on that income because it's recurring revenue. That in apartments, people always need a place to live. Therefore, investors value that income as being more certain and less risky. The higher the risk, the higher the return. Thank you for your time, and just remember, it's a great day to build apartments.